Okay, great. Well, reason for the call today, John, is something just came across my desk, John. It is perhaps the best thing I've seen in the last 6 months. If you have 60 seconds, I'd like to share the idea with you. You got a minute?
Lemonade stock, ticker symbol LMND, reported earnings before the bell today, and the stock is up 30% after what was a flawless earnings report. And we are going to talk about Lemonade, why the stock is up, and is the stock a buy right now. But before we dive in, if you could please go ahead, like and subscribe. It really helps me out. Now, for those of you that don't know, Lemonade is an insurance company. It is fully digital, AI first, with transparent pricing and a charity-orientated model. It's a strong fit for customers with straightforward needs like renters, homeowners, drivers, and pet owners who prefer fast service, low cost, and limited social impact. Now, you can see why the stock was up, guys. They beat on the analyst revenue estimate as well as the earnings estimate right here. We were looking for negative 80 cents, so the company is not profitable just yet. In earnings per share, the company reported negative 60 cents on $164 million of revenue against the 161 expectation. So very strong quarter, but this isn't the best way to look at Lemonade's financials. I'm just going through the overall basics. Now, gross loss ratio fell from 73 to 70%. This is a good thing. You want to see the gross loss ratio continue to move lower and ideally get into that 60 range, but this is the right stuff. And the 70% level right here for the GLR was the lowest it's ever recorded. Looking at adjusted EBITDA margin, this is sort of what the company guides for. We saw negative 24.3%, but a massive improvement from the same quarter last year, with adjusted EBITDA coming in at 42 million. Adjusted free cash flow margin was actually positive. So this is a free cash flow positive business. Negative, the margin there was 15.2%. Very solid margins. We'll talk about why that is, seeing 25 million in adjusted free cash flow. The company's cash, not including customer balances, for example, their float was 339 million, not billion, guys, million, and they have 123 million dollars in debt. So a fantastic balance sheet, and the company doing all the right things. They're losing money on an EBITDA basis, but making money on a free cash flow basis. You love to see it. Now, the company reported 34% in revenue growth and 16% growth in expenses. And this is how you build that operating leverage into the business. Now, the company actually did see a negative net income because their expenses are still well above their revenue of 164 million, as you can see, right? However, the company is growing its revenue faster than its expenses. And this is why the company actually guided for adjusted EBITDA positive in 2026, sometime in Q3 or Q4 in the back half of the year. But there's something I want to note with this company that's absolutely incredible. Have a look at this right here. General and administrative, right? That actually fell on a year-over-year basis. Technology development actually only increased by about $800,000. Sales and marketing is where we saw a massive increase. So all of the savings they're making, G&A, technology development, other insurance expenses, and loss adjustment expenses, they're putting into sales and marketing, because this grew like nearly 50% on a year-over-year basis. And that's what you want in a growth company like Lemonade. And hopefully by the end of next year, you should see this number turn positive, or maybe not the net income, but adjusted EBITDA. When we look at some of the other metrics of the company, in-force premium, or essentially just the premiums paid by customers, software companies call this ARR, annual recurring revenue, grew 29% to $1.083 billion. That's absolutely fantastic. Premium per customer increased 4% to $402. Now, this is absolutely crucial. Now, the growth here is always going to be in single digits, and this largely has to do with insurance regulation and price increase that the regulators allow them to do. However, customers increasing 24% to 2.7 million, guys. And we saw an acceleration in growth in customers, an acceleration in growth in in-force premium. And this is exactly what you want. When you see, your revenues increasing because your customers are increasing and you're able to increase pricing as well, this is what you should be doing as a growth company. At the same time, gross loss ratio, which is critical for an insurance company, continues to trend down. It hit the 70% mark. This is a trailing 12-month gross loss ratio. And I do think this trend will continue into the future. And if you have a look right here, the reason why I say so is because when you look at the gross loss ratio for the quarter, it came in at 67%, right? So even though the trailing 12-month gross loss ratio was 70%, we do expect that to continue to move lower. And if you actually look at ex-cat, which, it's a bit of nitpicking, that came in at 60%. So that's really good. It was actually 59% last quarter. Very interesting stuff. You could see that as the company has just started getting into Europe and car, the gross loss ratio is still above the 80% mark right here. However, pet and homeowners and renters insurance, which is the majority of their business for now, that's at 60 and 70%. And that's how we get that total 70% trailing 12-month gross loss ratio. Now, Europe was a massive, massive growth driver for the company. They mostly operate in the US, a little bit in Canada, but they've started expanding in Europe. And you could see right here, Europe is growing at a growth rate of 200%. They did $43 million in IFP this past quarter, and the gross loss ratio is in the low 80s, and that's 15 points improved year over year. So that was at 95% at the same time last year. So they increased premiums, reduced their gross loss ratio while growing like a weed. I do think Europe is going to continue to be a growth driver, and they officially have 250,000 renters and homeowners in Europe, and they're going to expand, and they'll be expanding into other verticals. Now, here's some comments on the European division. The management team said Europe diversifies our growth opportunity beyond the US with lower catastrophe exposure or CAT exposure and a regulatory environment that enables rapid pricing and underwriting iteration free of rate filing. This accelerates feedback loops and sharpens our AI-powered models and enhances pricing accuracy. Our AI-native platform scales across markets, spanning languages, products, and regulators. This is where it gets crazy. With no need for large local teams and country-specific infrastructure, this yields a structural efficiency that enables us to deliver attractive prices to customers. Further adding on to that, compared to when we crossed 50 million IFP in the US, our European business has a gross loss ratio of over 20 points better and delivers double the amount of new business per dollar of growth spend. Looking ahead, we see rich potential, deeper penetration in existing markets, new product launches, and stronger cross-sell focus. We believe that Europe will continue to be a key engine of rapid profitable growth for years to come. The company, on top of Europe growing like a weed, raised its guidance. They raised their full-year IFP guidance, gross earned premium guidance, and revenue guidance while reiterating their adjusted EBITDA guidance for the year. And they actually came out and said that we're looking to be adjusted EBITDA positive before the end of financial year or full year 2026. You can see here is everything in force premium. They're looking to guide for the full year of about 1.2 billion. You're looking at about a 29% increase for the year. So again, the company growing as a weed. Growth earned premium roughly the same. Revenue of about 710 to 715 million. And that's because of ceded income. It has to do with their reinsurance. We'll talk about that a little bit later, as to why in-force premium doesn't translate directly into revenue. And then for this full year, we're looking at an EBITDA loss of 140 million and then positive in 2026. Stock-based compensation of 61 million for the full year and then 74 million shares outstanding and then $17 in stock-based comp for Q3, as you can see the metrics right here. So the company doing everything it needs to do. Now let's talk about reinsurance, right? So the company, the reason why we actually saw a massive raising guidance had to do with their reinsurance policy, and we'll talk about it right here. The company said, we recently announced the renewal of our reinsurance program for the year starting July 2025. We renewed our coverage with a panel of long-term partners on terms materially similar to last year, with one notable difference. We reduced the proportional quota from 55% to 20% cessation. So essentially reinsurance is just reinsuring their book so they don't take on as much risk. So if they have IFP of $1 billion, 55% reinsurance means they pay that to another company to take on that risk. They will now only be paying 20% of that. And that's why we actually saw the guidance raise coming into this. LMND believe it is right-sized for their book at their stage of maturity. It's worth understanding that this decision was deliberate. We had a wide range of options available to us, including renewing on expiring terms. By reducing premium cessations related to a quota share reinsurance, we keep more of the business on our books and thereby retaining more revenue and gross profit. Our ability to make this move now is thanks to our consistent multi-year track record of improving loss ratios and more predictable underwriting performance. A lower quota share reinsurance cessation would typically increase capital needs and reduce capital efficiency with our regulated insurance subsidies. However, our improved loss ratio and expanded use of Lemonade RE, our wholly owned captive, offset these pressures, such as there's no material change in our capital plan. So even though they did reduce reinsurance, right, they do need to, increase their capital base to account for that additional risk, but their gross loss ratio and how they use their subsidiaries really goes to offset that additional capital burden. Now, if you are looking to get into Lemonade, the thesis is very, very simple. You're looking at a company, right, that's using AI. they are an AI first company, and you're looking at like operating expenditures remaining flat while in-force premium just absolutely skyrockets. And by extension, right, this is how you build immense operating leverage into a business. At the same time, right, the company is looking to 10x its book. Right now, they do $1.083 billion in in-force premium. They're looking to be a 10x over the next 10 years. And the majority of our product, right, and their car product is really what's going to take them to 10 billion through sustained operating leverage driven by AI and automation. Now, their car product, right, is growing very much like a weed while the gross loss ratio continues to fall. You can see the gross loss ratio fell. It was the lowest ever, just above the 80% mark at 86. And IFP for car was 150 million. So it makes up about 15% of their book currently. And this is the thesis. They're looking for sustained operating leverage used by AI, hard to expand, and then the company's margins to widen as they continue to take market share from legacy insurance providers. That is the thesis. Now, the street doesn't really get the thesis because the average analyst price target is $32 and they have an average consensus of hold. I do think that probably will change because I think the company is materially undervalued. So this is how I'm valuing the company. We're looking at the adjusted EBITDA figures right here. Okay, so we plug in the revenue growth for the trailing 12 month and then we grow that by, you're looking at about 25% growth every single year. Now, the reason why we have 36, 75, and 53% growth here is because as we scale from reinsurance of 55% to 20%, that's going to materially impact the overall revenue figures. Then we have adjusted EBITDA margin here, negative on the trailing 12 month, slightly negative in 2025, and then positive in 2026, and then 5, 7, and 13% in 2029. And I think this figure, right, can be like upward of 25% in the very long term. Then looking at adjusted EBITDA of 400 million by 2029, if we just apply a 20 adjusted EBITDA multiple, right, EV to adjusted EBITDA, you get an 8.1 billion enterprise value, subtract the net debt, divide by shares outstanding, which are increasing 3% every single year. You get a stock price of $97 by 2029. The current stock price is about $47. My fair value is $48. And you're looking at a compounded annual growth rate of 15.37%. Absolutely insane. And that is even after the 30% rally today. So do I think LMND's a buy? Yes. And I may even buy more after these earnings. So when should you buy? I think the stock, if we do get a pullback here to this $44, $45 area, right, find support, then we can go ahead and continue higher, hitting these 52-week highs right there. And ultimately, this looks like a very, very solid trend. You can see we formed a solid base right here. We had a massive move up. Then we had a downtrend. We put in a low. We had a move higher. We put in a lower high. Then we put in a lower low right here. So we're clearly in a downtrend, as you can see right here. However, what we did was then have a massive, massive rally after the tariff tantrum. We broke above this high right here. So we are now in an uptrend. We then pull back and form a higher low relative to this low right here. And we actually break above these highs. We're very clearly in an uptrend, right? If we do pull back, form a higher low above here, potentially in line with this level right here, and then continue higher, that would mean trend continuation. And then we can go target those 52-week highs. And I do think we're going to get there sometime before the end of the year, especially if the management team continue to execute. So what I would do is sell some cash secured puts 2-3 weeks out at the $44, $45, potentially $46 area and just ride the wave, try and get a sign because momentum is certainly on the side of the bulls. But guys, if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.